Welcome to the reality check of the market with the PPI come out today. Not as exciting and not as uplifting as yesterday's CPI. We'll talk about that. Mentioned it a few times in my live sessions this morning. Let's take a look at the charts. We got everything in red today. S&P down 0.42%. NASDAQ fighting back, still a little bit lower. We saw like a 0.2 down and then 0.4 on the NASDAQ. Now it's 0.5. So it's given back a little bit. We're just kind of hanging out in between yesterday's candle, which was a new all-time high for the NASDAQ. We have the Dow also down. This has been a pretty steady pullback on the Dow. This is one, instrument ETF that I would be fairly ready for a pullback towards the 50 or the 100. Probably starting to position myself for some 100 moving averages. So if we get to the 100, the 144, the 200, looking at some opportunities to get long the DIA. Nothing as of yet, but we're closing below 21, probably drifting a little bit lower. We will also see if the market can close back above the 21 and possibly work its way up to an all-time high. But the Dow has not made an all-time high since December 4th, which should have been a week and a half ago. December 4th was last Wednesday. So all-time high December 4th. The SPY previous all-time high, I think, was around the same time, December 6th. All-time high on that Friday. Yep. So Friday last week was an all-time high in the S&P. The NASDAQ has carved out some fresh all-time highs, including yesterday. Previous for that, we had the 6th as well. So that was Friday on the S&P and the Qs. And here we have this pop to the upside on the NASDAQ yesterday and then giving some back. Here is a look at, this is actually a good trace of yesterday's price action. So CPI, the market got all excited. And you can look here on the NASDAQ and see the same thing. That was a really stellar breakout on both ES. So a little 830 candle breakout, 830 candle breakout, nice rip to the upside for a few hundred points. Nice rip to the upside for about 30 points on the ES and over 230 points or around 230 points on the, 270 points roughly on the NASDAQ or the NQ. So pretty crazy stuff. And today, obviously, little disappointing to not have the continuation and follow through. But we're sitting here, choppy on the day, grab some profit on SPX. That's 5 for 5 this week. Waterfall income is still hanging in there. We've got one trade that's actually really close. I'm going to take a look at one right now. I may end up closing up a waterfall trade if I can get filled. Nope, never mind. I was looking at this trade earlier today. It was sitting around 28-cent debit with a take profit of 27. I'm just going to let this one linger. This one's good for another, 43 days, so I'm not that worried about it. My trade's on the SPY. I'm going to take a 610 call loss today. I've got some puts that are just out there into January. Those are outlier puts. And then my 605, 604 for waterfall is sitting around break even. So we'll just let the trades do what it needs to do. I keep talking about this, end of year, like next week. I mean, tomorrow's Friday, so we're already wrapping up the week. Next week is the Fed and BOJ back to back on Wednesday, Thursday, kind of the major, the last remaining catalyst for the year. I don't know if the Fed is going to say something that disappoints the market, if the Fed is going to try to intentionally say something to get the market all excited and jazzed up for 2025, or if this, kind of post-election structure. I'll make this pretty clean, right? So previous resistance here post-election. So we had our election breakout, big gap right here in the box. We came back and found some of that support. We found some efficiency there, and we made our way up to all-time highs. We've been drifting like those slightly higher highs, like fractions of 1% higher, but we're still carving out all-time highs, and we hit 57 on the S&P right there. All right. So here is my technical outlook for the S&P. Okay. Right now we're sitting where we have all-time highs that could still be tested, and we could still have a melt up into the end of the year where they start to get higher. Okay. Or if we breach this low, which the SPX is around 6018 and the SPY is right at the number 600. So if we hit 600 or lower on the SPY, okay, or 6018 on the SPX, if we breach these levels, I think we are giving back some gains before the end of the year. All right. If we hold this level, meaning let's say we come down here and we poke this low, we find this previous resistance to become support, I would look at it as an opportunity to, buy and see if we just range by the end of the year. Maybe we're not looking at all-time highs again by the end of the year, but perhaps we have a little bit of a range trade here where the market can go sideways for a couple of weeks and we can buy some dip opportunities. If Q1, as we kick off earnings season, I know I'm looking out a little bit further, but if we kick off Q1 earnings with Q4 data, I mean, things have probably done pretty well. So I think Q4 earnings is still on the docket for some strong prints, and that might keep this bull market going a little bit more. But what we're typically staring at now is like very low volume. And it is what it is. So next week being the last full trading week of the year, take a look at the calendar again right here. So today is the 12th, right? Tomorrow, final week of trading for this week, and then we have our final day of trading for this week, and then the 18th is the Fed. So I'll put this. Let me just type this in. So we have the Fed on Wednesday the 18th. We have the BOJ overnight going into the 19th. And that's pretty much it. And then we have Christmas Eve and Christmas Day. So that'll be pretty much disrupted by the holiday trading. So you'll have probably limited hours on the 24th and 25th. Maybe markets completely closed on the 25th, and I'm assuming New Year's Eve or New Year's Day, same thing. So New Year's Eve, New Year's Day, limited trading hours. Brokers are probably closed or partially closed or fully closed. So that means that whatever we have happening next week is going to be really key to see whether this market can hang on towards these all-time highs, possibly get to new all-time highs, even through this limited trading during the holidays. And I would even say that the 1st, 2nd, and 3rd of January are lumped into that. Even though it's disrupted, it is a new month. We probably do not have non-farm payroll on the 3rd, right? It's probably going to be the 10th, which is going to be the following week. So I'm just going to kind of put a squiggle line here. So interrupt the trading this week, interrupt the trading this week. And so we have this week to finish up. Next week is our last full week of trading with the Fed on tap. So will the market cling to these gains, cling to these all-time highs, possibly have a way to drive it higher? Possibly. I think that's the price action. So like I said, I'll make this analysis really clean. If we go into trading next week, all right, my technical level of support is this past resistance around 6018. If the SPX can bounce off that, I'm probably looking to take a bull put spread or a debit spread there so I don't have any assignment risk, but I might end up taking a SPY trade with a credit spread. SPY trade, Q trade, I look for some credit spreads. If we close below there, these are why I have hedges. So if we are going lower, I have a hedge in ES. Okay, that's my futures trade. I have a hedge in MES. That is my micro futures. I have a hedge in MNQ. That is my micro futures. So those are hedges. I also have a hedge in the SPY out to the middle of January. Okay, actually no, it's to the end of the month. I've got some outlier hedges out to the middle of January, and I've got a 608 by 590 on the SPY that is out to the end of the month. So if we go lower, then I have profit on all 4 of these. Okay, and if it really ignites and starts to get the Greeks really excited and starts to get some added volatility, probably going to be a good profit on that hedge. But I'm not necessarily planning on hedge profits. It's just part of the cost of protecting the portfolio if needed. So like I said, this level of resistance could be some support. I'll look at an opportunity to buy there. Okay, and if we just stay here for the next couple of weeks, as long as we don't do any damage to below 6018 or below 600 on the SPY, I still think there's an opportunity to look for some short-term buy opportunities. So right here, right, previous highs right around that 600 mark. You can see the chart right after the election. So election week, big gap to the upside, big move to the upside, faded all the way back into that efficiency, found that pocket, started a base, and here we are at all-time highs. Now, this week's candle so far is red. Is tomorrow going to be a move that gets us higher or lower to give us a directional week? Maybe, maybe not. It's interesting that we're sitting right here during the Fed next week. And also, this is some structure that I was watching. If you look at that trend line right there, I don't think it's a surprise that we faded off of that level today. So we came all the way up to it, we break the trend line, retest the backside of the trend line, and, take a look at your futures feed. Go into, let's see here, I can go this chart, go into futures, go into a smaller time frame. Okay. Futures feed wise, we had some head fakes down here. Okay. I would say that if we break, let me use a slightly different trend line, maybe something like this. So if we break that low, so if we get on the right-hand side of the trend line, if we take out this level of resistance becoming support, you can see the market bounce there. So there's resistance, there's support. If we get on the right-hand side of this trend line, let me find a price level on futures, 60.49 or 60.50. All right, so I'm looking at if we are seeing cracks in the bull market, okay, that would be the SPY below 600. That would be the SPX below 60.18, and that would be the ES feed or the futures feed below 60.49 or 60.50. Okay, I'm going to take a screenshot of that. Just to have it as a reference. Okay, so going into next week, if we just stay sideways, that doesn't necessarily mean that we break. Okay, we could go sideways and still stay sideways. We can go sideways and still go up. I think that the bears would have to make a convincing break to the downside. And if we take out this resistance, what would offer support, if that breaks down, there's room to run and fill back in and fade back in that election gap. Okay, so basically it's this. Here's your level on the SPY. Here's the trend line activity that I'm watching. We're on the backhand side of it right now. Okay, this does not mean that I'm bearish. Okay, but if we break below 600, the next spot that I would look would be to these lows and back into this election low. So if we break 600, I think we can get to, 585 pretty fast within, maybe 2 to 4 weeks. So if we break 600, it's been a nice little run, nearly up 28%. What would that decline be? Let's say that we drop to, 590 or back to these lows at 585. That would be a correction at the end of the year. 590 is about a 3% correction. So we still hang on to like a 25, 26 year S&P. We get back down to this, post-election equilibrium level. That's about a 4% correction, but we're still hanging out at, 23, 24% net for the year. So it doesn't do a lot of damage to the gains. It just kind of finishes out on a with a sour note. That may not happen. This market might just stay sideways. This becomes a really solid support level, and the market just hangs out here and then tries to get back, to all-time highs with Q1 earnings or other catalysts. Maybe the Fed doesn't say enough to really create any price direction, and we just have a bunch of noise and volatility. So we will find out, right? We'll find out what it gives us. But either way, keep your eyes peeled. So looking at head on a swivel, watching the big technicals, 6018 for the SPX, 600 on the SPY. Let's take a look at the Qs and see if I can find the same type of structure. The Qs are a little bit different because I would go post-election and I would put in a horizontal level right in here. Okay, so the Qs, we could pull back a little bit more into this area and still have some support. So the NASDAQ has a little bit more support built into it. We had the low from this week on Monday and Tuesday. So the low from Tuesday was that nice little pocket right there. We gapped higher on Wednesday's open, ripped up to all-time highs, had a really nice nearly 2% gain on the NASDAQ on Wednesday. And today we've been pretty sideways. We're also not breaking. Okay, we're also not breaking any major. Let me go back to, oops. What just happened there? Ah, nuts. What'd I do? Previous range. Darn it. Where's my green and my red? Gap fill, opening range breakout, initial balance. What the heck? All right, I think this needs to reload. Visibility, inputs. Ah, crap. That's not it. All right, anyway, I'll mess around with it. Let me just close out of this one and bring that workspace back up and see if it'll save it. There we go. Okay, what I was going to look at is going to a higher time frame. So let's zoom out for a second here. And if you look at the NASDAQ, I would say the structure that we're watching in the NASDAQ is somewhere out here, right? So we still have some pretty strong support in the NASDAQ. I wouldn't say this is necessarily bearish unless price were to break below this resistance. So this is resistance here. It's got to break below this level and also be on the right-hand side of this trend line. So until then, I would look at this area offering support. I would look at this previous resistance offering support. Unless we get back below, I'd say 515. So if I want to add this to a screenshot here, I'll add in QQQ less than 515. Okay. So those are the 4 key levels that I'm watching. Yeah, I think that covers it. I'll keep these, trend lines and boxes and things like that on the chart. I'm trying to make it look like super messy. But for me, I can kind of see through it and take a look at the big levels. So it's still bullish until it isn't, right? It's still bullish until price confirms. That's why I'm trying to get some really definitive levels and lines in the sand to say, look, the bears can still defend the NASDAQ. The bulls can still defend the NASDAQ. The bulls can still defend even this one here. The bulls can still defend the election. This is a little questionable on the S&P, right? We might be flirting with that trend line break. So watching that, but like I said, just to make this really simple and really clean, if we break below this previous high right at that chart alarm at 600, that's what I'm watching. Okay. All right. So we'll see what we get. FOMC next week. Not sure if they're going to be a major disruptor, if it's going to be a bunch of noise, maybe a non-event. I'm pretty sure they don't want to rock the boat, but if they, I don't know. I mean, you never know what they're going to say. And it's not really what they say. It's not like Jerome Powell's press conference is going to be any different. It's mostly how the market reacts, right? So if the market has like a strong reaction, through the Fed press conference or the day after or next week to finish out the week, we got to pay attention to that. If the market has, it would almost be nice to see this. Market sits here like at the lows, at support coming into next week, and we just kind of have some chop, and then we get into Wednesday, and the market goes all the way back to the highs again. Because if the Fed can kind of ignite the market to go higher, that momentum can carry us through Christmas week and New Year's week and see some all-time highs once again, right? But if we break lower, that's why I have hedges. So it's there just in case, but I'll be watching for some short-term opportunities. Okay. 15-minute charts a lot. No, I mean, I'm on the 5-minute charts just because this is what I'm trading every day for my daily profit play. We're looking at 5-minute levels. We're looking at 5-minute chop. We're looking at 5-minute bars. That's just an income trade on the daily profit play for SPX. So it's in this workspace, I can zoom out, right? I mean, the nice thing about this one is so far I've got Monday and Tuesday and Wednesday and Thursday. We've had winners all week long on our daily profit plays. And, I can see that their week is still red. Last week was bullish. The week before that was bullish. Week before that was bullish. Week before that was bearish. So I get a lot of perspective. Even though it's a smaller time frame, I can condense the chart and get a lot of information. So it's not that I like to use the 5-minute. I just, my morning trading, my daily trading is looking for that type of profit grab. Okay. All right. What else? We're sitting here at 605 in the SPY today. We're right in between the 600 and the 610. I sent a video out for my my double up alerts. So double up alerts right here. I dropped a video. I thought I did. Here it is. Yep. So double up members, you can also view an update under video update. I posted that today. So if I get anybody in my double up alerts program, I did about a 15 to 20 minute video on just current state of all trades, what's looking good for next week and what's not looking good for this week. I took a loss on the SPY, my 600 butterfly was a 26-cent loss. My 35-cent call today at 610 was a loss. Nvidia probably going to be a loss for tomorrow. So, I'm giving some back. We got some trades out to next week. If those, liquidity levels are hit, we're going to turn some nice profits by the 20th or the 27th. And I just wanted to set some expectations that as the market volume is thinning, I'm not going to be as active looking for these liquidity levels if the market's not wanting to move. So next week is really going to be almost an exclusive focus on, Mag 7 or SPY and Qs. That's probably the only instruments I'll be looking to really trade next week. I did take some profit on Tesla today. Okay. Tesla has been just nothing but up, and we hit some all-time highs. I had a bunch of trades in. I still have some trades in and still sitting on some profits. But the trades that I closed out a trade on Tesla. It would have been a credit spread and a bull call spread. So two trades. I'm not showing it right here. That's weird. Tesla. Okay, so here we go. So a 270 by 265 bull put spread. I collected, I'm trying to think here. I collected like 260 or 265 credit on the trade, and I closed it out for a 9-cent debit. So rather than waiting until January to get an extra 9 cents, that's all that's left in the trade, I just took the profit. So that was a 265 minus 9 cents. I collected 256 per contract. That was a nice little winner. That was over 90% of the gain anyway. The other trade I had was a bull call spread. So that was right here. My 250 by 255. That trade cost me like $2.40 to trade, and I closed it out for a $4.90 credit. So I've got here we go. So there's a bull put spread for 8 cents, so 90+% of the max profit. And then this one was going to be a max profit of $5. I closed it out for $4.90. Again, another kind of max profit of 90+%. I'm taking the money. I'm moving on. And the trades I still have running on Tesla, I have a ratio spread, which is a 230 by 225. It's just a put ratio spread. And then the 113 or the 130 by 115, that's another put ratio spread. Those right now are sitting up about $450 per account. That should be another probably $3,000 or $4,000 in profit on Tesla. Those are looking good to December 20th and January 17th. Those are way, way, way out of the money. We're trading at 416, and my ratio spread level is 230 and 130. So the odds of that getting hit is less than 1%. So I'm going to just take the full expiration and let this thing run all the way. I know I could close it out and reallocate if I wanted to increase the buying power, but right now with this trade, let me see what this closes for. I mean, it's still trading at like a 60-cent debit. I want it to go to zero, right? So there's no reason for me to, get out of the profit early when I can just let it go to January, because I'm pretty confident we're not going to fall 50% by January. In what, 36 days we fall 50% on Tesla? It's probably unlikely that it's going to happen. I'm in the one-click user interface, found the text version, no video. Let me log in and let me find it. One-click trading. Let's see here. Let me get logged in here. Okay. See if I can jump in and find that. So let's go to double up alerts and go to membership content. Okay, here. All right, let me drag this over. So mine's going to look a little bit different because I have the staff version or the admin version. But if I go into video updates, can anyone see a video update? That was what was published today. So open subscriber view. This should be what your class looks like. If you go to back, here's the subscriber view. This is what the membership area looks for members. Okay, so I've got alerts, help center, editorial. That's me. Here is the video update. So the same place you have your options trading bootcamp, scroll all the way down. Do you see this right here for video updates? It should be on your home page for the class. Membership area, and it should be posted under video updates. Papa John, let me know if you see that. If I click on that, it's right there, 21 minutes. There it is. So that's just in the home page. Just scroll down to the bottom. Francois, would you do any more credit or debit spreads on Tesla now? Don't think it's coming down anytime before earnings. No. I mean, I think there's been a pretty fantastic run right now. I mean, if I were to get involved in Tesla now, I have to be pretty much ready for a, look, if it goes higher, that's great. If it goes down, though, the difference is I was completely willing to own the stock. Anything under $200 or anything under $150, I was willing to put that in the portfolio and own it, at least for 100 shares. Now at $415, I want less ownership. So now the only trades I'd be considering would be, debit spreads or credit spreads. I know that this can keep ripping to the upside. I hope that it doesn't, I hope that just like everything else I'm looking at right now, I'd love to see Tesla, offer something like this where we have at least a pullback, right? We come back into some moving averages, we find some balance, and then we see if the market is able to, stabilize this thing to go higher. So I'd like a pullback into the, the mid 300s. I'd love a pullback, into the 200 moving average, but that might be wishful thinking. But this previous resistance becoming support. If we don't get a pullback, look, I can stack up a bunch of defined risk trades, something like this, and say like, okay, Tesla goes up. Let me see. Right now we're at 415. What I wouldn't do on Tesla right now is put anything in the short term. Okay. Because if I went out, let's say, 6 months or 8 months, if I started like staggering trades right now at all-time highs on Tesla, and I do like, let's put 8 for August, and then maybe in October, and maybe in December. If I did a 415 by 410, this could either be a bull call spread, so there's no assignment risk, or it could be a bull put spread, which would be potentially assignment. Do I want the assignment? Not really. Not really. If I did take the assignment though, it's like, man, where's the price? It's like, do I get assignment here at like $350? Am I only going to get the low point at like 400 or 375? I just think we have to have like a very healthy bull market for this thing just to rip the way that it's been ripping. This has come back in a long ways. I called this head and shoulders pattern, I'd say pretty well. We were waiting for this to be a head and shoulders. So that's part one of it. We were looking at this to be another head and shoulders. All these things were building up to a nice bullish breakout, and we got it, and this thing just surged. So the fact that we're here at these highs, I don't know. Is there more to it? Probably. Tesla is, it's a lot of things, right? It's not just a car company. The market treats it like it's an Elon Musk plus SpaceX plus energy plus disruption plus auto plus whatever. And it gets a lot of kind of juice, whether it's good or bad. It's been highly volatile for that exact reason, but also when it has a lot of fanfare and momentum. This stock can go like very few go. You can see this rip from 2020 into 2021. That was a crazy amount of gain. If I suppose on a higher time frame, this is a swing to correction. If we're still pushing to a wave 3, then yeah, there's still upside here. But the only thing that concerns me would be just simple fundamentals based on discounted cash flow. I know that some of these valuations when stocks are hot doesn't really matter. Come on, Tesla. What the heck, man? There we go. Okay. So volatile share price, high level of non-cash earnings. Earnings are growing, forecasted to grow. These are all good. Price to earnings, price to sales, a little high, right? Discounted cash flow model. This is what makes me nervous. Okay. So we're trading at 424 with the discounted cash flow model showing a $90 fair market value. So let's just say that we'll split the difference. Let's go from 90 to 420. Okay, so that puts us up at 510. That's a $255 compromise to say, okay, if I wanted to own some shares of Tesla, even at a higher valuation, let's cut it in half. Do I think Tesla's going to come back to 255 anytime soon? Probably not. So I don't know. I think it's had a good run. I think the best thing for me to do on Tesla, in all honesty, to keep it pretty risk defined, is to basically say, look, if I put $1,000 in Tesla right now and it goes higher, I turn that into some profit. So if I took this entire area, let's say, if I was more aggressive, I'd say 2 and 3, right? Or if I was a little bit more conservative, I'd say 1 at the all-time highs, which feels like garbage. 2 would be the breakout point through the election, and 3 would be this support all the way down here. If I could just say, okay, there's $1,000, I would even say this is a $1,500 allocation, and there's another $1,500. So I've got $3,000 in here and $1,000. That's going to move my break even to probably somewhere in this area. If I get $4,000 invested and it goes up another, what's that percentage? I'm obviously like eyeballing the gains here, but if I had $4,000 allocated that goes up 52%, I mean that's a $2,000 return. That's good, right? $2,000 profit on what only cost me, maybe $3,000 to $4,000 to invest. So that's a pretty good return on risk. That's probably the easiest way for me to trade it, is to be an owner. Because if I do options right now, it's like I'm establishing a line in the sand. My options trades would be right, and price has to go higher for the way I'm going to trade them. I'm not looking to do bear call spreads. I'm not looking to short Tesla, not right now. But do I like the price that it's at right now? I mean, no. I love that it got there. But I've taken profit along the way. All my bull call spreads and bull put spreads and all my ratio spreads and all these things that I had built up, they just all paid out. So that's the good thing. The only bad thing is, like, this thing has gone 100% in a few months. So if you own the stock, that would feel pretty good. If you're trading options, I still made, 100% is not like my entire account, it's on the position. So if I did have, if I bought it at $200 and I put 20K cash on the line, well, that 20K cash would be worth $20,000 profit. Like, that is fantastic. But I allocated way less than that, and I probably had about, $5,000 in risk, and I still generated about $8,000 in gains. So there's 100% upside on the stock, and I still generated over 100% on my return positions based on the options risk that I put in. So when it's all said and done, it's fine. But I wish I had more invested, obviously. But anyway, Palantir, and it's the same thing on Palantir. I said this earlier this morning. If you see any stocks that look like this, okay, it could be Tesla, Palantir, Carvana, Progressive, Apple, Meta, Netflix, Google, it doesn't matter. If they're all sitting here way overstretched, okay, we are 40+% away from this 200 moving average. That's a big movement. Okay. Now, I'm not saying that Tesla hasn't been there before, but the last time we were 40+% away, what did we see? There's about a 49% distance away from the 200 moving average, and we spent months retracing to it. So I think a lot of these stocks have stretched far enough that we're going to have some type of pullback, some type of catch up to the moving averages to offer a discount or offer a correction, just offer anything that's not just buying freaking all-time highs. So I don't want to be stuck buying at all-time highs. Now, if I'm going to justify something on Tesla, which I do think has the potential to be $1,000 stock, I really do. Okay. If I put $1,000 on the line now and I bought fractional shares and I did another, let's say, $1,000 to $1,500 here. Okay. So my max risk is $2,500. And how do I lose that money? Tesla goes to zero and I would lose $2,500, which is 1% of my account. Okay. Is that going to happen? Probably not. So if I had a break even here at $2,500 and we go up to all-time highs again, and this ultimately does become $1,000 stock, well, I've got a $350 cost basis. So what's the difference? Okay. If we go up from 350 to 1,000, and this is obviously in the future, but if I went from 350, let's say, to 1,000, I'd have 180% gain on my invested capital. So if I have, I'll just say $2,500 invested. So $2,500 invested times 1.87, I turn that into 46.75. It's a pretty good profit, right? So that would be what I'm walking away with on top of the position. So I mean, I turn $2,500 into almost 7 grand. It's pretty good, right? With a 1% risk, and end up making like 3 to 4% gain. But it's going to take time. And Tesla is not immune to the overall market sentiment. Tesla might chop around here. We might have a lot of volatility, but I'd rather stay the course and not be, because I've had this happen. If I really like a stock and I can catch a bit of this bull market, I can stack up a bunch of expirations and orders, and I can kind of waterfall those in. Not really a pun intended because I run a waterfall service, but I can say that I like the trade, I like the direction, I'm going to stick with this for the next 3 to 6 months. Those trades all end up paying out really, really nicely. Okay. But when we've made the run like we are, and now I'm starting from scratch, I can't justify getting into heavy positions, staggering out credit spreads or debit spreads, and looking at this and saying, this is a good spot to enter, because it's really not. Okay. I don't think this is a good spot to enter at all. Okay. But I will say this: Tesla has earnings. Okay. What I would say is on the shares that I do have, if I bought some shares right now, I would definitely want to have a put to protect the downside, because I could lower that cost basis for a fraction of the cost. So back to your question, Francois, on any stock. This goes for anybody looking at their stocks. Any stock that is stretched way away from all the moving averages. I use a 2150, 100, 144, and 200. Anything that looks like it's way, way far away. Hasn't touched a moving average in a minute, right? Up to all-time highs, going into no man's land. I'm not going to be crazy aggressive and bullish, right? The time to be aggressive and bullish was 3 months ago, was 6 months ago, was 11 months ago, was this entire year had an opportunity to be pretty darn bullish. And it's paid pretty well. Going into 2025, it's a clean slate. As a trader, I usually, like, objectively, it's like I need the Men in Black tool. I just flashbang my eyes and I forget about everything, and I just have to trade what I see. If I trade what I see, I'm not getting aggressive on Tesla, nor Palantir, nor Apple, nor Netflix, like all these stocks that are just all-time highs and running. I'm just going to wait, and if I have to patiently wait, so be it. But I will sit on cash at the ready and I'll wait. So anyway, let's see. Here, I'm going to go ahead and do this. Okay. We're talking about this. I'm already thinking about how I'm going to trade Tesla. So here's what I'm going to do. I like the stock around $362. I'm going to buy $1,000 worth at 362. So $1,000 divided by 362 would allow me to buy about 3 shares. Doesn't sound like a lot, might be chump change, but if I'm going to throw out $336,000, I'm not going to. I'm going to allocate about 1%, okay, or less, and I'm going to say this is going to be my position 1. Position 1 is going to be a patient pullback, okay? Position 2 would be the election breakout. And I'll sit there with a break even in between. If we get back to these highs again or we go higher, that could be like a $2,500 position that goes up and maybe makes me 100%. That's a pretty good return on capital. I tie in $2,500 and I make $2,500. I get 100% return on capital. That's pretty good. But I'd rather do that, and that's what I'm going to do. So I'm going to put in a buy trade at 362. I'll go 362.50. I'm just going to make it simple. I'll make it 3 shares. Okay, 3 shares, and it's going to be a pending order. All right. So 3 shares pending order. Let's go to trade. This will be long stock, go, and I'll take this down to 3 shares. I'll set a limit order at 362.50, and that would set me back around $1,100. So this is going to be good till canceled, of course, and that trade is now pending. So everyone's going to get a piece of this action. 362.50. I'll put this in my tracker. All right, let me move through these accounts really quickly. Okay, 8051. Okay, so that's a 362 entry. I'm going to put this in my tracker. All right, so this is going to be Tesla. All right, so pending buy at 362.50 for $1,100 allocation. Okay, the next level that I would consider buying would be somewhere between this 275 and 285. I probably go along the lines of the 285, so it's not as price sensitive, but probably a 285. Okay. And if I did 285, let's go another, I'll go 1,500 bucks there divided by 285. I could buy 5 shares for that. So I'm going to go ahead and do this again. I'll put the trade in. So this would be pending buy at 285 for a $1,500 allocation. Should be just shy of 1,500 bucks. So now I'll go long stock, 285, good till canceled, and this will be 5 shares, and that's going to be a 1425 allocation. Okay, so I'll go 285 for 5 shares, and just go through the lineup again. And just like that, I've got 2 levels that I'm interested in. It's ownership, so it's not something I have to play around with options. I don't have to time it. I just own it, and I can work around it. I can still trade options if I think I've got a better price. I can stack in my, bull call spreads and my bull put spreads and stack in my ratio spreads, and I can trade the volatility when it's high. So anyway, I can do all those things. Okay, there's my 285. Okay, I think this one already has it. Yes. Okay, and then 1608. Okay, this one's going to be a 1608 for 285. Got it. And 2 more accounts. There we go. Okay. So that account has the 2 orders in. 2 orders in. Okay, good. So I've got it in. Good to go. All right. So there is a little trade on Tesla. Let's go $1,100. Oops. Write this out in text box. So $1,100 at 362.50 and $1,500 at 285. So right in there and right in there. Those are going to be my levels where I want to get some Tesla. Now, if I have pullbacks, okay, pullbacks to my 21 moving average, I'll probably put in some credit spreads. Pullbacks to my 50 moving average, I'll probably put in some credit spreads. I want a discount. If I don't get one, I don't get one. Okay? But I'm not going to chase this thing. That would be like saying, what do I want to do in Netflix? This is another very easy example to see. If I look at a stock chart and it looks like this, where from these highs to this pullback zone, 26% overextended, plus we haven't hit a bar count for 200 and some bars. I mean, we're 290 bars away. That is a decent, healthy bar count, right? So having price moved this far in time and moving this far in distance away, I just can't justify trading at all-time highs. So I'm going to wait. We pull back here, way more interested. Pull back here, way more interested. In fact, one of the easiest trades for me might be this. It might just be put in 500 bucks, put in 500 bucks, put in 500 bucks, put in 500 bucks, put in 500 bucks. Build my position here, maybe a 1 to 2% allocation. And if we get back to these highs again, turn it into a nice gain, right? And that alleviates the timing with options where I could still be wrong. That alleviates the risk and the drawdown, the assignment risk maybe at a stock that I'm really not wanting to own 100 shares of. I mean, I'm not that excited about putting $90,000 of capital on the line or $45,000 of margin. That's a lot, you know? So for me, it's like if I'm owning anything, that's why my options portfolio is usually dollar cost averaging at really inexpensive levels now that we can do whatever share size we want. And then trading options when I feel like I would either be willing to own the underlying or obviously at a level that I think I can establish a line in the sand and then see price go above it or below it. Okay. I agree, Harry, and I said that too. I mean, I said that about Tesla. That's why Tesla was such a weird stock to trade this year because it really was all about Elon Musk. And it's really this simple. If Elon Musk in the Department of Government Efficiency is a giant flop, or it's some type of like scapegoat or patsy for some garbage going on in the government, Tesla might take a hit for it. You know, so could I see Tesla being a stock that gets all the way back down to a fair value at $100? I mean, technically speaking, that'd be a huge disappointment for Tesla, right? If we come, but I will say this: look, if I do a $2,500 allocation, if I did $2,500 here as a break even, and we came all the way back down to this level, I would gladly put another $2,500 in and stack up a bunch of options and turn this into a nice winning combination. You know, but that would have to be an incredible disappointment to see Tesla be that volatile and lose all that. Anything can happen, but that's why it's also under control. You know, now if I bought 100 shares and just said, "Yep, I'm going to put $40,000 on the line," well, that could disappear real quick, right? That goes down 50 to 60%. I'm not happy with that. If I get $2,500 to go down 60%, I'm not that worried about it. I've got plenty of dry powder. But it is going to trade a lot like the sentiment on Elon Musk and the sentiment of the DOGE. It's weird, you know, but it is what it is. So that's how I'm trading it. You can either like it or not. But same thing on Netflix. Netflix give me some pullback. I'll average into some Netflix. There's previous highs all the way back at $700. I'm not interested in owning the stock at 900. This has been fractional shares along the way. But at this point with options, it's like just see if Netflix can pull back. I just canceled my YouTube TV subscription because they're deciding to up the cost again. So they've gone from $49.99 a month now to $82.99 a month starting in January. Like that's enough for me. I barely watch live TV anyway, so I'm out. I'll save $1,000 a year now. Cool. So I mean, is Netflix going to keep jacking up their price? Now it's $19.99 or $20 or $17 or maybe. I mean, if Netflix gets up to $30, $40, $50, I'll probably cancel it. Like I don't like it that much, you know. So, are there challenges? I don't think so. I think Netflix is they're look as a streaming service with added subscriptions and revenues. I think they are cementing themselves once again to be the king of streamers. Disney Plus has had its issues. Amazon Prime, they essentially lump it in free with an Amazon Prime membership, so you get Prime Video, but now they have paid ads, and you can't even watch something for free. It's all paid ads, which is annoying. Amazon's added in live sports and kind of replaced modern day pay-per-view. Their content, sometimes it's good, sometimes it's garbage. I think you have an interesting like personal Netflix test when you get onto your library and you check out things and you're like add to queue, add to queue, add to queue, and then you never watch it. It's probably time to give up Netflix for a little bit. Or if you get into what's on Netflix and you can't find anything, it's like they have a lot of content, but it's not all great. But I think they are, they're pretty revolutionary when it comes to they've been a consistency in the streaming arena for a long time. And what they're doing right now with live sports and events and the popularity and the money they throw at things, they can definitely bring a crowd. So I think Netflix is totally fine. Is it valued at these levels? I mean, let's find out. Let's just check what's discounted cash flow. What's the premium that we're paying for it? Okay. Earnings are forecast to grow. Earnings are growing. There's no risks. That's good. What's price to earnings, price to sales? It's cheaper than Tesla from a price to earnings, price to sales ratio. Okay. This is what I don't love. Okay. If we're trading 936 and fair value at 776, obviously I want a discount, right? I want to buy things at fair market value. I want to buy things on sale. That doesn't mean that I'm a value investor, because value investors will sit on garbage stocks for years, hoping that they eventually, get to the multiples that they think they're going to go to. Look, there's a lot of momentum behind Netflix. This thing might hit $1,000 before it pulls back, but if it pulls back and it's still fair valued at 760 or 776, I will patiently wait to scoop it up and dollar cost average in. Okay. I can't share the charts, Papa John. I can just share images. Like if I were to go into my take a snapshot full screen mode, I can take a snapshot and I can copy the link. What do you want? What chart do you want? I can't just share the charts for you to like navigate yourself. I would just have to take an image and share it. Any chart you want me to share? All right. Anyway, I've got a webinar in 8 minutes, so I'm going to wrap things up here in just a minute, and I want to grab a drink because I can feel like my throat is dying on me. And another chart talking about the end of the year stuff and into 2025. There are two charts I think you need to put on the radar. Okay, this little 10-year note that continues to go higher. This is not a good thing. If anybody wants to buy a house in 2025 and this is going higher, that's not a good thing. If this is neutral, it's fine. If this is lower, it's better. Okay, I know the Fed's going to cut rates next week. It's like baked in at 98%. We'll see what the yields do. If the bond market is trying to call the bluff and say, you idiots are cutting rates and inflation's getting higher, this 10-year yield might continue to, call the Fed's bluff. And that's why also the narrative from Jerome Powell in December next week and also into Q1 of next year, I know they're paying attention to this. It is completely backwards reaction if they are cutting rates here and the yields are going 80 points higher. I mean, if we get to this point, this would be the biggest flop for the Fed as far as like they've made a massive mistake and the bond market is trying to snuff it out. If they cut rates here when the 10 years trading at 3.7, okay, and all of a sudden this thing goes up to 5%. That from a percentage increase is ridiculous. That is one of the worst policy mistakes we would see because the bond market is basically calling them idiots. So I don't know what's going to happen, right? I don't know if this 10-year bond is going to chop around, but if we break above 4.5, I'll be very nervous that higher inflation numbers can stretch us to 5%. That is going to make the market struggle. There's no way that the equities market can get above 5% and see even 5 to 6%. Look, this would be probably a flashing red light, and this would be a red light and horns and all the signs to go with it that the economy is about to tank. So very cautious, with this 10-year yield trying to go higher. I don't think anybody really pays attention to it because it's not in the news, but everything is built around this as a financing mechanism. And if companies need money to borrow, if you're trying to service growth with debt, which we certainly do in the US and the entire globe, this is going to make things a lot harder. Servicing debt is going to be a huge line item in 2025. It already is. It's just going to get worse. Okay. All right. So that's one thing I'm watching. And also the 10-year and the 3-month, we are starting to inch our way back up to the 0 line. If we get out of this disinversion, so we had this inverted yield curve, the deepest and longest that we've ever had historically. And if we get out of this to the disinversion, you look at this 10-year and the 3-month, the disinversion has been undefeated since 1980s on recessions. Okay, so what I noted here was, when did the actual recession start? We disinverted, we had borrowed time. That's why I put borrowed time, because it doesn't mean it happens immediately, but usually within about 6 to 12 months of this disinversion, this 10-year and 3-month, we are in a recession within a year. On average, about 12 to 14 months. So just something to be throwing out there for 2025 to just give us a reality check. Things have been good for 2 years. Things have been pretty simple for 2 years. Doesn't mean it's always going to be simple and easy. Just be prepared to grind. All right, I'm going to go. I got 4 minutes for a webinar. Papa John, let me throw I'll throw some screenshots together and post them on my Telegram. Okay. If anyone wants to join me for the webinar, I'm going to be live at 4 p.m. It's right in here, so it's the quickest way to Thanks. This is the quickest way to jump in, so I'll share my Telegram link right now. Some of you that are already in it, it's already there, so go ahead and jump in. Otherwise, this would be 4 p.m. webinar, and that's a Chris Pulver Telegram link. You can join the channel and sign up. Okay, webinar's at 4. And I'll be running that thing Han Solo. All right. Cool. All right. Thanks, everybody. If you're jumping in the 4 o'clock webinar, I'll see you then. Okay. It is a sales webinar, by the way. It's more people in the service. Jack Carter was with me twice this week. I'm doing another session today at 4 p.m. And there's another live trade on Waterfall coming on Monday next week. So, all right. I'll see you in a little bit. Thanks. Bye.